Have you ever pulled up a financial chart and just felt like you were staring straight into the matrix? Just a chaotic mess of red and green lines going everywhere. Well, you're definitely not alone. But here's the real secret. Those candlesticks, they're literally the language of the market. Every single candle is telling us a story about buyers, sellers, fear, momentum, and liquidity. And once you learn to actually read them, the whole chart suddenly makes perfect sense. Let's get into this explainer.
Okay, let's dive right in. A lot of newer traders will literally just stare at cheat sheets, trying to memorize the exact geometric shape of a candle. But I gotta warn you, simply memorizing shapes without understanding the actual mechanics underneath, that's exactly why so many retail traders end up failing. The market isn't some geometry test you can cram for. It's a live, breathing story. So here's our quick roadmap for today. 1. The language of the market. 2. Anatomy of a candlestick. 3. Bullish and bearish battles. 4. The psychology of price. And finally, 5. Rejection and failed moves. Starting off with Section 1, the language of the market. Stop guessing and start reading. All right, to ground ourselves, let's establish exactly what a candlestick fundamentally is. At its core, it's just a visual representation of price movement during a specific defined time frame. So if you're looking at a 1-minute chart, every single candle you see represents exactly 60 seconds of trading activity. Flip over to a 1-hour chart, and that exact same single visual block compresses an entire hour of price action. Pretty straightforward, right? Moving right along to Section 2, Anatomy of a Candlestick, breaking down the battleground. Let's move to and see how this builds. Every standard candlestick is made up of 4 specific data points, which traders usually just call OHLC. First up, you've got the open. That's exactly where the price started when the time frame kicked off. Then you have the high, the absolute peak price reached during that time. You have the low, the absolute bottom price. And finally, the close, which is where the dust settled and the price ended when the clock ran out. Now, I love thinking about this through a really powerful visual metaphor. Think of the thick part of the candle, the body, as the conquered territory. It shows the actual distance between the open and the close, telling us who actually won that time frame. Then you have those thin lines sticking out of the top and bottom. We call those wicks, or shadows. These represent the extreme highs and lows. This is the fought-over territory, the battleground where the price traveled, but the opposing side pushed back hard before the time was up. That brings us to Section 3, bullish and bearish battles, identifying the victor. And this brilliantly illustrates the two sides of the war. A bullish candle is usually colored green. This just means the closing price was higher than the opening price. The buyers were stronger, they pushed the price up and successfully held their ground. Conversely, a bearish candle is usually red. This tells us the closing price was lower than the opening price. Sellers brought heavy supply to the market, completely overpowered the buyers, and drove the price down. But guys, here's the massive catch. If you stop learning right here, you are going to have a really bad time. Literally anyone can memorize that green means yay and red means uh-oh. But honestly, 95% of traders stay stuck and unprofitable because they only memorize these basic shapes. If you don't understand the context or the traps being laid out behind those basic colors, you're completely missing the real story. To bridge that gap from a level 1 novice to a level 2 pro, we have to look past the shapes. Knowing the shape of a candle is just clinical textbook knowledge, but true profitable trading, that requires the discipline and patience to understand the dark emotional psychology behind why that shape formed in the first place. Let's get into Section 4, the psychology of price, moving from novice to pro. So the absolutely crucial point here is this. Level 2 trading dictates that you stop memorizing. When you see a massive candle, I want you to literally ask yourself, is this smart institutional momentum stepping into the market, or is this just retail panic, with everyday traders capitulating and getting stopped out? You have to realize the chart is literally a heartbeat of market liquidity and human fear. Let's look at what complete market control actually looks like in real time. For a strong bullish setup, we're talking a massive green body with tiny wicks. This means buyers took control from the very first second and never let go. It's immense buying pressure and pure momentum.
On the flip side, a strong bearish candle is a huge red body with almost no wicks. And let's be honest, seeing one of these form against your position, it's enough to induce a mild heart attack. It is pure, unadulterated selling pressure. It usually points to a violent momentum sell-off or pure retail panic where everyone is rushing for the exit doors all at once. Which perfectly sets up Section 5, Rejection and Failed Moves, the smart money traps.
Enter the rejection candle, which you'll often hear called a hammer. These are incredibly important because they show a failed price movement. Imagine a candle with a tiny little body at the top and a massive long wick pointing straight down. What's the story there? Well, it tells you that sellers aggressively tried to push the price down into new territory, but they hit an absolute brick wall of buy orders. The buyers violently rejected those lower prices, swept up all the liquidity, and pushed the price all the way back up before the close. It's a massive sign of total exhaustion from the sellers.
Now, what's really interesting about these specific setups is exactly why retail traders lose money on them. They enter way too early. They see the price dropping super fast and jump in to short the market right as the smart money is preparing to reverse it on them. They just get completely swept up in liquidity grabs. It's like they're treating trading as a video game for the fastest clicker, rather than actually waiting for structural confirmation that a reversal is happening. Entering trades based on that impulsive, emotional fear of missing out, rather than patiently waiting for the candle to actually close and confirm the market structure, that is a silent account killer. You do not get paid for acting first in this game. You get paid for being incredibly patient and reading the story correctly when the setup is actually confirmed.
So as we wrap up this explainer, I want to leave you with a provocative thought. How are you going to read the market story tomorrow? The next time you open up your charts, please don't just see a random assortment of red and green shapes. Look for the conquered territory. Look for those fought-over wicks. Keep an eye out for the traps, the momentum, and the underlying psychology. Start applying this advanced perspective right away and just watch how the language of the market finally starts speaking directly to you.